G'day, folks. We've had some technical difficulties. I completely lost internet connection at my end. I'm not sure how much you heard, and I'm not sure who's actually out there at the moment. But I'll just continue on. Sean, perhaps could you come in and just let me know how much of what I covered actually got broadcast?
Yep, Gary, I actually lost the connection as well for a brief moment when you dropped off. I've just come back.
Right.
So the last thing was you were just finishing up on. Oh, where were you? I think you were just finishing up talking about Apple.
Oh, okay, right. All right, I'll go.
Doubled,
yeah.
so.
Okay, thanks. All right, well, I'll pick it up from there. So sorry about that, folks. There's not a lot I can do when the internet connection gives up the ghost. So anyway, moving on. So looking at Skyworks. So I'll just go back and cover that again. Skyworks is a stock in the semiconductor industry. It's a terrific business, been growing at high growth rates. Was trading at $25 in November of last year. So in about a year, it's gone from $25 to $60. You'll notice the 150-day moving average, the red line, has been going up at a strong rate. The price has been well above it, indicating real strength in the trend. And this is the first time that we've really got a crack at it at a technically attractive price for quite some time. Now, this is not an exercise in just ticking the boxes because it's now got back to the 150-day moving average and it's now oversold, etc. Doesn't mean it's necessarily a buy. Again, you've got to put it into context, and that context is that there's some pretty nervous markets at the moment, and that all may get clarified during the US reporting season in the next week or two. Corporate Travel Management is an Australian company and this is a pretty rare trend in Australia at the moment. You can see that this trend is really accelerating. The 150-day moving average is starting to head up at an even faster rate, and you can see that the price of CTD is way above the moving average. And again, there's hardly a stock on the Australian market that's trading at its all-time highs, yet this company is. So here's an example, or an exception, I guess. Now, you'll notice the opportunities arose where I've put these little green boxes. Whenever the price pulled back to the 150-day moving average, here, and again here, these were ideal entry points for good profitable trades. Now, NXPI, I mentioned, is another one in the same industry as Skyworks. The trend was the same. The setup was exactly the same, and it's worked beautifully for the last couple of years. The price has moved from around $30 to about $75. However, on Friday night, the price took a 13% tumble on a broker report, which I believe will prove to be not relevant to this company's situation. However, we now have a pretty dramatic price move. So you wouldn't want to just go blasting into this stock at this point in time. Let's see how it pans out, and a good entry may become available. Now, all great trends finish. Here's what you should look for, and it's what I call a change of character. And that change of character normally comes associated with some added volatility. And again, I've been really focusing on this in the weekend videos that I do of late. Now, what I'm looking for here with the change of character is a significant break of the 150-day moving average or the previous low, generally both things. Now, it requires just a simple understanding of phase analysis, and the phase 3, which is the transition from a bull market to a bear market, has a starkly different character to it. And I'll go through an example in just a minute, but when you see the difference, it's really chalk and cheese. But the key thing here is that one's mind has to be open to spot it, because generally it's not what people are looking for, and our mind is very good at tricking us and blocking out things that it doesn't want us to see. So the key parameters of this change in character in the market, and this applies to either an index or to a stock, is that there is a significant break of the 150-day moving average and the previous low with some big range candles. And the index may swap over from living mostly above the moving average to being below the moving average. And that's what we're seeing at the moment. We're certainly seeing it in Germany, in other places in Europe. We're seeing it in the American small caps. We're certainly seeing it in Australia. So there's definitely been a significant change in character that's really it's been on for quite a few weeks, but it really got well and truly confirmed on Friday night. Now, there's almost always a secondary rally or a lower peak which forms. And the final confirmation is a break below the initial spike. And I want to go through this with JB Hi-Fi as an example. So here's JB Hi-Fi. We can go through a couple of cycles where this has occurred. We're looking here at the moment, right over on the left-hand side, you're looking at September 2008, and obviously to the current day. Now, the price reached a peak in November 2009, reached a peak of about $23. This stock was an absolute market darling. You'll notice that the red line is heading up very strongly. The price is way above the red line. So that was the character of phase 2. That was the bull market in that stock. Now, the first alert that something different may be occurring happened around February 2010 when the price broke down below the 150-day moving average. Now, no real confirmation there and no real need to take any protective action. But when we got over here and the price had now spent a significant amount of time moving average on the 10th of February, but by the time it got to May, which is 3-4 months later, the price is still below the 150-day moving average, which has now rolled over. See, the red line has rolled over? That is when you were really on notice that the character of the market was changing, or the character of the stock was changing. Now, the price subsequently had one last little fling, formed a lower high, and then started a breakdown. So by the time we got to here, by the time we broke back below this support line, so at around about $20, you should have been out of that stock. That was enough evidence that the character had changed quite significantly and it was time for you to get out. So you should never ever have lost money on JB Hi-Fi, because if you bought above $20, then you had no business doing that, because that just wasn't the entry point. And if you did buy back down here, then all you were doing was crystallizing some, substantial profit. Now, the ultimate test was when we broke these lows. And that didn't occur until May 2011. So it took another year for that stock to muck around, go up and down, go sideways, and then eventually it all fell apart. And then we went down to below $8. So here was our phase 3, and here's our phase 4 decline. We then saw this all repeat out again. So we started back into a phase 2 rally February of last year. We peaked out, started to look like things were getting a bit dicey here, late April, early May. You should have been out of JB Hi-Fi in May of this year, and you can see now that it has now broken below key support, and we're now down at $14.50. Now, you can apply that analysis to any stock or to any index, and it just tells you where you are in the overall scheme of things. Just let me look at the S&P 500. This is a big picture of the S&P 500. Now, at this point in time, you cannot say that the character of the S&P 500 has changed. Now, other indices definitely have. The German DAX is falling apart. The FTSE looks, pretty shaky, and certainly the Russell 2000 in America has broken support and is into a phase 4 decline. But you'd have to say that at this point in time, the S&P has not. And it's highly likely that we'll form a lower high. Even if this is going to be the end of the bull market in the S&P, it'll form a lower high over the next few months, which could take a year before it ultimately falls. So if you're worried about being caught out in a big correction, please just remember what I've just talked about with JB Hi-Fi and the principles. You get months and months and months of warning before those sort of very significant moves occur. Plenty of time to get out of the way. Okay, so the big corrections can be avoided. All you need to do is look at the price chart, but the hard part is acknowledging to yourself what you actually see. So the news will often be good. The sentiment will generally be very buoyant. With JB Hi-Fi, when it started, the price started to break down. It was still a market darling. Everyone loved it. It was still on all the broker recommendation lists. So if that's where you're taking your cues, then that's where you get into trouble. So why are most people blind to that part of the process? And I think it's because the phase 2 bull market was such good fun. It was so profitable that our mind just tends to shut out the fact that the party's over. We don't want to acknowledge it. So it's very simple to spot when the big corrections are coming. You get plenty of time to get out of the way, but it's actually difficult to do if you're, out there on your own and you're being swamped by what the media's got to say. You're being swamped by your own thoughts on things, and quite often you'll just turn a blind eye to it. So this is where a dedicated mentor is just so invaluable, and I'm not trying to make a case for myself here, but it's just the reality. I've worked with literally thousands of people over the last decade and a bit, and I just see the same process over and over again. People who try to do things on their own, they might be quite knowledgeable at what they're doing, but they just don't have enough experience, and they're not close enough to the market to recognise what it is that's staring them in the face. So 99% of people don't have the time or the inclination to really do this effectively, in my opinion. Research is important. Working on your behaviour is absolutely vital. A couple of questions again for you to ponder. How do you react under pressure? And I guess everyone's been put under some pressure in the last couple of days. Do you tend to make knee-jerk decisions to unexpected events? And the way that the market fell apart in the last few days in America was certainly unexpected. So for me, it's a chess game. You've got to think ahead. You've got to raise cash at appropriate times, because market turns can be very sharp. It's impossible to make money longer term if you are unprepared for bear market declines. It is absolutely impossible. You have to be able to cash up before the bear market starts. Just think it through. If you go into a bear market fully invested, even if it's fully invested in a whole bunch of really good stocks, you get to the bottom, even if you've got the courage to hang on through all of that pain, you've then got no cash to take advantage. And you've then got to wait probably a year or two to get your money back on the stocks that you're in. It's just so difficult to do. So this is a chess game. You've got to be 1 or 2 steps ahead of the curve, not just reacting to the market as it unfolds. Now, very quickly, I just want to look at a couple of stocks that were, again, I mentioned that this webinar was prepared a week or so ago before all of the last few days, but it's still valid, I believe. Wells Fargo Bank, which is the best bank in America and possibly one of the best banks in the world. Gilead Sciences we've already looked at, and if you want to put all the semiconductor shares together, there's an index, an ETF index that you can buy called ROM. So let's have a look at that one as well. And we have go. So this is ROM. So this is the semiconductor index. You can see we've had a fabulous uptrend. That index has gone from around 70 to 150. So it's doubled in the space of about 18 months. Opportunities to enter were here in October 2013. We got another opportunity here in April of this year. And that's really been about it. It's actually been pretty hard to get your hands around this one. But on Friday, we had a sharp sell-off. So we're now back to a point that could be construed as a good entry point. We're oversold, but again, as with Skyworks, you don't want to move on this just now. Let's see how it unfolds. Wells Fargo Bank, again, you can just see the strength of the trends. They're just exceptional, and I can point you towards literally hundreds of these in America. All the little green boxes all indicate where the entry criteria on a technical basis were. The stock ticks the boxes as far as all the pre-filtering goes, and at this stage still in very, very strong uptrend. Now, just a bit of a dose of reality. The easy era in the Australian market is finished. The easy money in the banks, the easy money in a lot of stocks that we've had over the last few years is finished. And I really encourage you to accept that that is the case. The second dose of reality is don't expect to be a good stock picker if you are doing this part-time. If you spend a few hours on a weekend, or you subscribe to a few newsletters, or whatever it is that you do, don't expect to be a good stock picker on a part-time basis. Markets are too fast-moving. There's too many things to consider these days for that to be the case. It's not to say that you shouldn't do it, but just be aware of the limitations that go with that, because it just requires too much concerted research and too much monitoring. You just have to be immersed in the market every day to gain a sense of when to move and when to cash up. And again, it comes back to this chess game. You can't play the game if you are reacting to the market as it hits you in the face. You've got to be one or two moves ahead of the market if you want to hope to do well. Some vital questions. So we're almost to the finish here. Just, again, some questions for you to think about, because the purpose of tonight was about your learning, and I want you to take as much value away from tonight as possible. And it would be great if I could just give you a formula where you tick some boxes and you could go away and do this all yourself. But unfortunately, that's not the reality. So please give these questions some thought. Do you have a clear strategy that you operate to? Or, as many people do you tend to react emotionally and you buy near the peaks when the mood is good and you sell near the lows when the mood is poor? That's not a criticism, it's just how we are wired psychologically. It's very hard not to do that. Secondly, are you focused on buying the dips, as I've talked about tonight? Do you think about fundamentals? And do you think about value? Do you pre-filter the stocks that you are buying before you even get to look at the chart? Do you ever second guess the market and miss opportunities? So you've got great information in front of you, but you just can't pull the trigger at the right time. Thirdly, do you reliably execute your plan if you've got one? Or are you just after stock tips, or you're just after the latest fad? And forgive me for being a little bit bold tonight, but I'd like to bet that a few people on this webinar tonight are probably here to try and get a few free stock tips and think that they've actually got something of significant value. Sorry to disappoint you folks. This is the best research and the best information I can give you, but it's pretty close to worthless if you deal with it out of context. And in 3 months' time, this information, or at least the specific stock tips, will be out of context because things would have moved on dramatically. Next, do you adopt a global view? And what's happening in the local market is a perfect example. You know, are you stuck in the Australian market and you're not thinking more globally? And how have you reacted in the past around market lows? Because buying quality assets at good value at such times is an absolute no-brainer. If you want to make money, then learn how to pull the trigger around market lows on high quality assets. That's how you make money. And are you stuck with a home bias? All right, that's the formal part of the presentation. I do apologise for the interruption that we had to the internet connection, but that's the gremlins for you. Now, I'm going to take some questions, but just before I do that, so I'd encourage you to certainly have some questions ready. But before we get to that, I want to give you a couple of options about what you've learnt tonight. The first option is that you can learn how to do this yourself. All the processes I've gone through tonight, I can teach you and I can help you do that with the appropriate level of support that you need. The second choice you've got is that let me produce the results for you if for whatever reason you don't want to learn or you don't want to do the various things that you need to do. And that's quite understandable. We all have really busy lives, and perhaps going to global markets is not something that you just feel comfortable with, and that's fine. But if that's the case, then you can still access the results, by letting me do it. So the purpose of tonight was about giving you information so that you can make better decisions. So what I'd like to do is to offer to you the opportunity to communicate with me directly one-on-one. I think that's the best thing that I can do for you. Just to help you think it through. Now, I'm not going to try and, hard sell you and convince you to, do something that you don't want to do. This is purely about giving you information and perspective so that you can make better decisions. So if you'd like to do that, then contact me. I'll put my email address up here. There we go. And whilst I can't give you personal advice, I can answer your questions on pretty much anything to do with the market. And I can provide a perspective that will help you make better decisions. I've been doing this for a long, long time, and I've worked with lots and lots of people, so I know that communication will help you. Being immersed in global markets is what I do. It's my life, it's my passion, and it pains me to observe so many people who just totally muck it up. And they do it over and over again. It's just plain crazy to think you can keep doing the same thing and expect better results. So, bottom line, I can help you do it much better if you'll let me. Now, if you're in the markets, there's always risk, but as I've said in my email, doing nothing over the longer term is probably your greatest risk. So, I'd really encourage you to look at the opportunities. So that's all I'll cover for the moment. So I'll pass it over to questions. So let me go through. So the first question is from Matthew. Is the real skill in picking the bottoms so that you can buy at the bottoms? Look, Matthew, it's a good question. We can never be sure that we're picking the bottom. The charts I showed you tonight, you can see that when we've got strong uptrends and you buy around the 150-day moving average, that 9 times out of 10, it tends to be the bottom. And then away we go. However, there will be times when it won't be the bottom and there will be, some further downside. And right now, this might be one of those times. So you've got to have a plan for how you deal with that. Making money in the market is, I've called it a chess game. It's so important to anticipate in advance what can go right and what can go wrong. And the better you prepared you are with a risk management plan, then, the better you're going to do in the market. So it's all about anticipating, what if it doesn't work out the way that I expect? How do I deal with that and what's my next move? So I'm not trying to pick the bottoms. What I'm trying to do is to pick high probability points. And I know that if I keep doing high probability things, that I'll finish in front. That's the essence of it. So I don't ever think that I will pick the bottom. And that's why I always use a stop loss, because I acknowledge to myself that the transaction I'm about to do may not work. And I think it's really important to understand that decision. Next question from Craig. Is the 150-day moving average exponential or simple? Look, it's just simple. I don't get too hung up on the specifics of technical analysis. The important thing here is the ability to step back, see things that are pretty simple. Hopefully you all acknowledge that the process that I went through tonight technically is pretty simple. But the hard part is getting your mind to accept what you see. So whether it's simple or exponential, I don't really care. You can use either because it doesn't really make a great deal of difference. What is important is that ability to step back and recognise what is happening for what it is. Okay, alrighty. That's all the questions that have come. Oh, there was one other question. Are we in a bear market? And in Australia, I think that refers to. And did that bear market start before the GFC? And if that's not the case, then what will the indices do? It's a pretty timely question for right now. So let's have a look at that. And then I think that'll be the last question. We'll probably call it quits from there. So the Australian market at the moment, here's the ASX 200. So you can see that we were certainly in a phase 2 bull market in this period with a little bit of weakness in June of 2013, but since then we've been in a pretty strong market. Now you've now got to say that the Australian index has now been below the 150-day moving average for long enough, and it's gone deep enough, and the moving average is rolling over to say that the character of the market has changed. There is no question that the bull market in Australia is now finished. What we don't know at this stage is, will this be just a big sideways mess that will, you know, go up and down and whipsaw us in and out of the market for the next 2 years? Or will we go up and form a higher low and then go into a phase 4 decline? In other words, an extended bear market. I don't know the answer to that, and I probably won't know the answer to that for 6 months. But I know what it looks like, and I know how to play it. So at the moment, there is enough evidence there in the Australian market to say, be really careful in the Australian market. So that's my answer to that question. That's it for tonight. Again, sorry about the interruption. The webinar is recorded. It'll be recorded in 2 parts. So if for any reason you've missed part of it, then you'll be able to pick it up online. Thanks very much for your participation, and I would really love to hear from as many of you as possible. That's it for now. Cheers.